Hi everyone, welcome back to Saheb Academy. Today in the 7th video of cash flow statement chapter, we are going to solve our 6th problem, and the question is from the ICAI study material, practical question number 11. The name of the question is Ryan Limited. Now this is not the Ryan Limited of illustration 6, this is different. Okay, so there are two Ryan Limited questions in the study module, so don't get confused between those two. Illustration 6 is different and practical question number 11 is different. All right, so this is going to be a very important question because here we have got adjustment like revaluation of land, and the profit on revaluation has been transferred to capital reserve, and then interim dividend paid is there, and then there is pre-acquisition dividend received. So this is going to be a very important question. So let's see how to solve this and all. Okay, first let's just read this and analyze what has been said over here. Let's read. Now see here, from the following balance sheets and information, prepare cash flow statement of Ryan Limited by Indirect Method for the year ended 31st March 2021. So here we have been given two balance sheets, balance sheet of 2021 and 2020. So this is our previous year and this is our current year. So what you have to do, you have to look from right to left, isn't it? This is your opening balance and this is your closing balance. So let's see, first we have share capital, as you can see over here, note number 1. Let's just go to the note number 1. See, in the note number 1 we have equity share capital. Equity share capital from 5 lakh opening balance has increased to 6 lakh. Why equity share capital has increased? Maybe the company has issued equity shares, isn't it? More share capital has been issued, so that is why it's increasing. Yeah, that's our thinking right now. And then next we have what? See here, we also have redeemable preference shares, right? And then that's all. Yeah, so what has happened with the preference share capital? See here, opening balance was 2 lakh, closing balance is nothing, right? It's 0. Why? Obviously preference share capital has been redeemed. Yeah, so what you have to do about that, if it has been redeemed, you have to just deduct in financing activity. Everything that is related with capitals, it comes in financing activity. So issue is added, redemption is what? Subtracted, because outflow is happening, right? You all know that. Yes, so share capital is over. And then see, you are seeing over here there has been increase. Immediately you also have to look into the adjustment. There are adjustment in this question. See here, lots of adjustments are there. There are no adjustment regarding what? Regarding equity shares and preference shares. So directly you can understand just by looking over here, issue has happened, redemption has happened. Like that you have to approach the question. Okay, right. Next we have, see, reserves and surplus, note number 2. Let's just go to the note number 2, reserves and surplus. First we have capital redemption reserve. If you know the knowledge of redemption of preference shares, then you know that whenever preference shares are redeemed, what do? We replace the capital either through creation of CRR out of free reserves and then fresh issue of equity shares, right? Isn't it? Yes. So now here CRR has been created. See here, in the opening balance there was no CRR. In the closing balance we see there is 1 lakh of CRR. So CRR has been created during the year. Okay. So CRR has to be created out of free reserves. Yes. So free reserves like general reserve, profit and loss. Yeah. So now we have to understand, is CRR created out of profit and loss or not? If it is yes, then we have to reverse this in the operating activity. Okay. Under appropriations. Yeah. Creation of CRR is an appropriation. So if you are starting from retained earning in the indirect method, you have to reverse this. But if it is created out of GR, general reserve, then you don't have to reverse because it's not impacting the profit. Okay, don't worry, we'll see about that. Okay, next see, we have capital reserve. So capital reserve is also, see, from 0 it has increased to 70,000. So we have to see, there is an adjustment regarding that. We'll open a ledger account and we'll see what is that. See, capital reserve consisted of profit on revaluation of land. They have revalued the land upwards. Okay, then whatever the profit was there, surplus was there, it has been transferred to capital reserve. So that is why that 70,000 is appearing over there. Is it clear? We'll see. We'll prepare the working note, the ledger account, and we'll see. We'll just star mark it right now. Okay, next we have, see, general reserve. What has happened with general reserve? See clearly now. General reserve from 2,50,000 opening balance, it has increased to 1,50,000. It has increased by how much? From 250 to 150, it has increased by 1 lakh. So you can think, you can make an assumption that CRR is created out of general reserve only. There is a decrease in general reserve of 1 lakh and CRR has increased by 1 lakh. Okay, so you can make an assumption that CRR has been created out of general reserve only. And the question is also silent. Yeah, question hasn't said how CRR has been created. So you have to make assumption over here. Is that clear? But still, we'll open the ledger account of general reserve and we'll see the whole picture and it will be clear to us. Fine. All right. Next, what do we have? Any more reserves? Yes, we have profit and loss account balance, right? The retained earnings. So how much is it? See, from 50,000, it has increased to 1 lakh. How much it has increased by? It has increased by 50,000, right? So that 50,000 is what? That's the profit after all adjustment, the retained profit. Okay. So from here, we have to start our indirect method journey. You all know we have 3 starting points, isn't it? We need net profit before tax. That's our first priority. But if it's not there in the question, we check, do we have NPAT, net profit after tax? If we don't have this also, then we have to start from retained earnings. And here we get that, right? The difference between the closing balance and the opening balance. 1 lakh minus 50, that's equal to 50,000 retained profit. Clear? Okay, understood. Next, what do we have? Next, see, we have, reserve and surplus is over. Next, we have, see, non-current liabilities, long-term borrowings, note number 3, 2 lakh. All right. So now, what about this long-term borrowings? Let's just see in the note. In the note, we have, see, 9% debentures. I've told you, whenever they say rate of loan or debenture, then you have to immediately understand there is a hidden adjustment of interest expense. Yeah, interest payment. Is that clear? Yes, understood. We'll do that, hidden adjustment. We'll calculate how much interest is there on the debenture, and what we are going to do, whatever interest expense is there, that we are going to reverse in operating, and then whatever we have paid, that we will deduct in financing. That's the hidden adjustment of interest paid. Is it clear? Okay, understood. Now see what is happening to debentures. Forget about interest. Let's talk about the debentures balance. See here, debentures in the opening was 0. Yeah, in 2020 it was 0. In the current year, at the end, it has, become 2 lakh, from 0 to 2 lakh. So what has happened? Obviously, we have issued the debentures, but still there is an adjustment regarding debenture. If we'll see the additional information, there is an adjustment over here. See debentures, right? So we have to open a ledger account for this, and we have to see the whole picture to get the complete clarity. Okay, what exactly is happening? Right now, we can just assume little bit, just by our thinking. At the first glance, there might have been issue of debentures. Okay, so it will be added in financing activity. But how much to add? Do we have to add the entire 2 lakh? We can't say. There might be, what do you say? We have issued debentures for non-cash. It can happen. Okay. It is not necessary that entire 2 lakh money we have received, because we also issue debentures for non-cash also. If we have to buy any asset, we can issue debentures. That can also happen. So we have to look into the adjustment and verify that and prepare the working note. All right. Okay. So long-term borrowings is over. Moving on, then we have current liabilities, trade payables. Trade payable is a current liability. What do we do of that? We consider that in working capital changes. It's increasing, isn't it? From 1 lakh 10, it has become 1 lakh 15. It has increased by 5,000. So we are going to add that in working capital changes while doing the operating activity. You all know that. Next, we have other current liabilities, note number 4. From 80,000, it has increased to 30,000, right? But there is note number 4. Let's go to the note. Let's just see the whole detail, right? We can't make any conclusion just by looking at the balance sheet. Yes, we have to look into the notes as well. So if we see in the notes, we have dividend payable. I've told you, whenever we have dividend payable, we have to make the working note, right? So star market. Fine. See, 60,000 opening balance is there. 60,000 opening balance is there, and closing balance is nothing, 0. So can we make an assumption that this 60,000 is paid in the current year? Yeah, we can make such assumption, but understand, you have to look into the adjustment. Are they saying anything about the dividend in the adjustment? See here, interim dividend was declared and paid. So we have to open the ledger account. Is it clear? Okay, fine, understood. We'll open the ledger account and we'll see what's happening. Yeah. Next, what do we have? See, in other current liabilities, we have liabilities for expenses. So we assume this is a operating current liability and we'll consider it in working capital changes only. What is happening to that? It is increasing by 10,000. So we are going to add this. Okay. Next, what do we have? See, next we have, other current liabilities are over. Then see here in the balance sheet, we have short-term provision for tax, they are saying in the bracket. Always remember, dividend payable, provision for tax, always we open a ledger account to see the whole picture. Okay, so here see we have opening balance 60,000 and closing balance 95,000. We'll take it in the ledger account and we'll see that. Okay, just star market right now. Then what do we have? We have assets. See, non-current asset, property, plant and equipment. Yeah, PPE. So that's note number 5. Let's go to the note number 5, property, plant and equipment. So here we see we have plant and machinery. What has happened to plant and machinery? From 5 lakh it has increased to 7 lakh 65. This is an investment activity item, right? So right now we can just think that we might have purchased a plant. It is increasing, but to get the whole picture, see, you have to open the working note because there are adjustments on that. Okay, plant was sold and then plant was purchased, right? So we have to see the whole picture while preparing the working note. Okay, next what do we have? PP, do we have anything else? Yes, we have land and building. In land and building, see what's happening, from 2 lakh it has decreased to 1 lakh 50. So it seems we have sold the land, right? So we have to prepare the working note, start market right now, and there is an adjustment on that also. We have sold the land, we have revalued the land, and then we have transferred the profit on revaluation to capital reserve. So definitely we have to open a land account, okay, land and building account. Is it clear? Yes, and then in the question they are also saying that depreciation has not been charged on building. So what does that mean? It means maybe they have purchased the building at the year end, or just forget about that. We will not charge any depreciation and all. Okay, we are not preparing profit and loss statement. We are preparing cash flow statement. We do not charge depreciation and all. Whatever has happened in the profit and loss and balance sheet, we just give the effect of that on the cash basis in this statement, cash flow statement. Okay, so nothing we are going to do about the building depreciation, no reversal, nothing, because it has not been charged. That's what they have said. Fine, don't worry, we'll prepare the ledger account, we'll discuss more about that. So PPE over regarding PPE, is that clear? And here they have given us what? They have given us WDV, remember that, okay, written down value. All right, so next what do we have? After PPE we have non-current investment. What's happening to non-current investment? From 80,000 opening balance it has become 50,000, 30,000 decrease. So that means we may have sold the investment. So what do we have to do? We have to open the ledger account and we have to see the adjustment right now, whether there are any adjustment regarding that. Yes, see the third adjustment, part of the investment was sold for 70,000. All right, so there's an adjustment regarding that. So we have to star mark that as well. We'll open an account for that. Okay, an account is needed for this as well. Okay, then see current asset, we have inventories, operating current asset. What's happening to this? From 90 it is increased to 95,000, increase of 5,000. Current asset increases means cash is decreasing, you have to subtract in the working capital changes. Trade receivable is also increasing, the same way you have to subtract. How much increase has happened? 25,000. From 2,25,000 it has become 2,50,000. So 25,000 increase, you have to subtract 25,000 in working capital changes. Next you have cash and cash equivalents, opening and closing balance, which will be the last two items. Yeah, you all know that. And then we have other current asset. Now students get confused regarding this other current asset. What do we have to do? See, it's really simple. You have to see whether there is any note or something. If there is note, then there might be advance tax in that. Then you can't consider that in working capital changes. It will be separately done in the ledger account, the treatment of advance tax, right? And then there can be prepaid expenses in other current assets. So that is what operating current asset, that will be considered in working capital changes, isn't it? Prepaid expenses. Yes. And then if the question doesn't say anything like this, other current asset, then what you have to do? You have to assume it's an operating current asset and you will consider it in working capital changes. Is it clear? Simple and straightforward. Fine. So that's the whole analysis of this balance sheet and everything. And then here are the adjustment. Okay, so let's just go through these adjustment and just prepare the working notes. Now see the first adjustment. A piece of land has been sold out for 1,50,000. The cost of that was 1,20,000 and the balance land was revalued. Capital reserve consisted of profit on revaluation of land. So it's really simple. We have sold a land for 1,50,000. The cost of that land was 1,20,000. So obviously we have made how much profit? 30,000 profit. Easily you can understand. And then they're saying the balance land was revalued and whatever profit on revaluation was there, that is transferred to capital reserve. So if in the balance sheet we find 70,000 is there in the capital reserve. So that is what? That is nothing but profit on revaluation of land. So let's just open the ledger account of land and building and you will easily understand everything regarding this, how it is affecting the profit and cash flow statement. Okay. So see, what's the opening balance of land and building? Opening balance of land and building is 2 lakh opening balance and closing balance is 1,50,000. Yes. So see here, land and building account, opening balance on the debit side, closing balance on the credit side, 2 lakh, 1,50,000. First, what did we do? We sold off the land for how much? For 1,50,000. So land and building, Yeah, land is decreasing because of 1,50,000 sale. That's the sale value you have taken. You have got the money, so it's an inflow under which activity? Investing activity. You have to add it. You all know that. And the cost of that was 1,20,000. So how much profit you made? 30,000 profit. That profit has to come on the debit side. You all know, to profit and loss account, 30,000 in the bracket profit on sale of land. Okay, so what do we do of this? This is an indirect income which is sitting in the P&L. Yeah, it has been credited in P&L, added in P&L. To reverse, what you have to do, it's a non-operating item. You have to subtract. You have to subtract in operating activity. Is it clear? Simple. And then see, you will just balance this account and you will find how much is the revaluation profit. Okay, so 1,50,000 plus 1,50,000, that's equal to 3 lakh. 3 lakh on this side as well. 3 lakh minus 30 minus 2 lakh, that's equal to 70,000. What is this 70,000? This is nothing but profit on revaluation of land that has been transferred to capital reserve. So you will write to capital reserve. Now tell me how the effect will flow of this capital reserve to cash flow statement. No effect. You have to just completely ignore. Why? Think about it. What impacts cash flow statement? If the cash is getting affected, it impacts cash flow statement. If profit is getting affected, then in indirect method, it impacts the cash flow statement. Here, because of this capital reserve, is profit getting impacted? No. Is cash getting impacted? No. So no impact on cash flow statement. You will not do anything about this in cash flow statement. Is it clear? Okay, see 70,000, it has come over here. It is sitting in capital reserve. That's fine. That has nothing to do with the profit or cash. So just ignore that. Is it clear? Simple and straightforward. First adjustment of land is done. Okay, it's done. The second we have is, see, on 1st April 2020, a plant was sold for how much? For 90,000. That's the sale value. Original cost 70,000 and written down value 50,000. Now, what will you compare to calculate the profit on sale? You have sold a plant. So how you will compare? You have to compare the sale value with the WDV. Okay, WDV is 50,000. You have sold for 90,000. So 40,000 profit you have made. Okay, let's just prepare the plant account, plant and machinery, and then we'll do this. See here, plant and machinery opening balance is 5 lakh, closing balance is 7 lakh 65. So in plant and machinery, see here, opening balance 5 lakh and then closing balance by balance C by D 7 lakh 65. Is it clear? Simple. Then what happened? Then we have sold the plant for how much? For 90,000. So machinery is decreasing. Yeah, plant is decreasing because we have made the sale 90,000, isn't it? By bank, you will write in the bracket sale. And this is what? This is an inflow under investing activity. So it will be added. You all know that. Simple and straightforward. And then we have made a profit of how much? 40,000. We have sold for 90. The written down value of that is 50. 90 minus 50, that's 40. Profit always comes on the debit side. To profit and loss, profit on sale. Yeah, same like over here only. The same logic. Okay. So what will happen of this? The same way it will be subtracted in operating activity, like how you did over there. The same logic. Okay. Fine. And then what happened in the question? See, you are done with the half adjustment. Then they are saying, yeah, the first part is over of the second adjustment. That was sale of plant. Then they are saying something else. See, and debentures worth 1 lakh were issued at par as part consideration for plant of 4.5 lakhs acquired. So what is happening over here? Understand, we have purchased a plant of 4.5 lakhs, 4,50,000. And in return, what we have paid? We have got a plant of 4.5 lakhs. In return, what we have given? We have given debentures worth 1 lakh. We have issued debentures for non-cash. Okay. And then remaining amount has been paid in cash. That's what you have to understand. Okay. That's the common sense. Yeah. How can we get plant of 4.5 with just giving debentures of worth 1 lakh? It can't happen. Remaining 3.5 has been paid in cash. Is it clear? Understood? Yes. So see here, let's just do the posting of that. Plant and machinery is increasing. Yeah, we have bought a plant of how much? 4,50,000. We have given 1 lakh worth of debentures. So 2 debentures 1 lakh, and then the remaining 3,50,000 we have given cash. Yeah, through bank account, of course. So to bank. Is it clear? This is what is this. Okay, these two postings are of purchase of plant. Now understand that debentures which are issued for non-cash, do you have to take that in cash flow statement? No, of course not. It is not impacting profit. It is not impacting cash. It can't be taken in the cash flow statement. We just have to ignore that. Okay, understood. What about this bank? Of course, money is decreasing in your business. You have to subtract it in the investing activity. You have purchased a plant. It's an outflow under investing activity. Clear? Simple and straightforward. So you are done with these two. This is also done. Done. Now, we prepare this account to calculate depreciation, isn't it? To get the whole picture how effect is flowing, but the main objective is to calculate the current year depreciation, which is not given in the question. Okay, in the question what they have said, in the question if you see, they have just said, see, on plant and machinery we charge depreciation of 15%. So do we have to calculate 15% depreciation and all? No, we have done everything. Whatever the balancing figure will be there, that will be the depreciation. Is that clear? Okay, we have done everything now. So only the missing figure is this red ink. That's the balancing figure, which is nothing but depreciation. Fine. So see here, 5 lakh plus 40 plus 1 lakh plus 3 lakh 50, that's equal to 9 lakh 90. Here also 9 lakh 90 minus 7 lakh 65 closing balance minus 90,000, that's equal to the depreciation 1 lakh 35,000. That's the current year depreciation. What do we do of that? In indirect method, we add that back as a non-cash expense, right? We reverse it. Yes, that's what will happen of that. Is it clear? Okay, so you are done with two adjustment right now because of this plant and machinery account. You are done with second adjustment and you are done with the this seventh adjustment as well. Yeah, plant and machinery depreciation is also done. And then they are saying no depreciation has been charged on building. What about this? See, have we charged any depreciation over here? No, isn't it? Everything got balanced out just by taking the profit on sale and the revaluation profit. Yeah, this was the balancing figure. Which one? This capital reserve, isn't it? Yes. No depreciation in land and building. You don't charge depreciation on land, but building, we charge depreciation on building. But understand here the question is saying there is no depreciation charged on building. So what can we do? We may assume that maybe building has been purchased at last, at the end of the year, maybe, or just forget about it. Okay, maybe it has not been purchased. No depreciation, maybe the building has not been constructed, who knows. Okay, then moving on. Next, which adjustment do we have? See, next we have, see, investment, third adjustment. Part of the investment cost 50,000 was sold for 70,000. Simple adjustment, right? Let's prepare the investment account. In investment account, we find out what's the opening balance. Check where is the investment account. Yeah, non-current investment. Yeah, here is the balance, non-current investment. From 80,000, it has become 50,000. So simply we can take it over here, investment account, debit balance. Opening balance on the debit side 80,000, closing balance on the credit side, buy balance 50,000. Is it clear? Simple. They have said we have sold the investment of how much? 50,000 cost for 70,000. Investment we have sold, so it is decreasing by 70,000, the sale value. We have got the money by bank. It will be added in investing activity, isn't it? Inflow of cash. And then the profit that we have made is how much? 70 minus cost 50,000, that's equal to 20,000 profit. Profit always comes on the debit side. Yeah, the same logic, subtract in operating activity because it's a non-operating income. We reverse that. And then they are saying what? And then they are saying something else here. The fourth adjustment also, pre-acquisition dividend has been received. Pre-acquisition dividend has been received. We have discussed about this. You can go to the conceptual video to understand the logic and everything. There is a timestamp, directly go specifically to that part and just understand that. It's really simple. Pre-acquisition dividend, we treat it as recovery of cost and we subtract that from the cost of investment. Okay. Now why and all? You have to watch the video, conceptual video. So pre-acquisition dividend, what we do of that is, see here, investment account will be reduced. Investment account will be credited because of 5,000 dividend which we have received, and it's a pre-acquisition dividend. Okay, so buy dividend like this you have to take, but we have received it in cash, right? So this will impact the cash flow statement, isn't it? See, you have to reduce from the cost of investment, that's fine, that's the accounting treatment, but you have received the cash, right? So obviously it will come in the investing activity also. So in investing activity, what you have to do, you have to add this, it's inflow. Okay, normally what happens when they say dividend received, we say it has been credited to P&L. It's a post acquisition dividend, that's what we assume, and it goes to P&L, right? So we have to reverse it in operating activity. But this dividend, pre-acquisition dividend, has it gone to P&L? No, it has not gone to P&L. Pre-acquisition dividend is not sitting over here. It's not. So you will not reverse it. That's the important thing you have to remember. You will not reverse. Fine. In indirect method under operating activities, you will not reverse. Fine. Understood. So pre-acquisition dividend over. Then you will balance this account. 70,000 plus 5,000 plus 50,000, that's equal to 1,25,000. Okay, 1,25,000 over here as well. 1,25,000 minus 20 minus 80, that's equal to 25,000. So you have a balancing figure on the debit side. So what does that mean? Balancing figure on the debit side? It means you have purchased more investment, isn't it? If there is a balancing figure on the debit, see here there is plus. Investments are increasing because of this amount. Why investment increases? Because you have purchased more investment. Okay, that's the common sense. That's the logic behind all these things. Understood? Investment account also simple and straightforward. Okay, so what will happen of this? This is an outflow. You have purchased more investment. Money is decreasing in your business. So you will subtract it under investing activity. Fine. Next, which adjustment do we have? Next, we have an adjustment of, see here, interim dividend, right? What they are saying? Interim dividend was declared and paid at 15% during the year. Okay, what is interim dividend? Interim dividend means the dividend that is given between two AGM, right? Which is declared and paid in the current year only. It's not like final dividend. Fine. So in the same account only we'll do the treatment. Remember that. Okay, we don't open separate account for interim dividend and all. In the same account of dividend payable, we take the treatment of final dividend as well as interim dividend. Okay. So see, let's open dividend payable account. In the question also, in the balance sheet also, we have dividend payable. See here, 60,000 opening balance. So let's open dividend payable account. See here, dividend payable account which has a credit balance. Credit means plus, debit means minus. Opening balance is how much? 60,000. Closing balance is 0. So that's 0. All right. And then in the question, what they have said? In the question, they have said interim dividend was declared. You all know. Where does declared dividend go? Declared dividends come over here by profit and loss. Yeah, isn't it? In the appropriation, we deduct that while preparing the statement of profit and loss. Yeah. So by P&L declared in current year, 90,000 will come over here. How 90,000? From where did this 90,000 come? You have to calculate on the closing capital. See, 6 lakh equity share capital is there, right? The closing capital 6 lakh. On 6 lakh, you have to calculate 6 lakh into 15%. That's equal to 90,000. This is the interim dividend amount. Okay. So that has been declared in current year, right? So you will take it over here. Is that clear? And then we have discussed in the conceptual video, whenever we have like this opening balance just given, we assume this is the dividend declared in previous year, not in the current year. Okay. In previous year. So that is why this 60,000 is not coming over here. So what will happen of this 60,000, this opening balance? We assume it has been declared in the previous year and dividend has to be paid within 30 days since the declaration. So we can rationally assume this has been paid in the current year only, right? So with this assumption, we take it over here plus 60,000. 60,000, this dividend which was declared in the previous year has been paid in the current year. So it will come over here. Okay. And then 90,000 is the interim dividend. So in total, how much has been paid in the current year? 1,50,000 has been paid. Okay, 90,000 is the interim dividend declared in current year, paid in current year. Final dividend, it was declared in the previous year and it got paid in the current year. Is it clear? So this is how it is. Find 90,000 plus 60,000, that's 1,50,000. And then that's it. Okay, you can also find it as balancing figure if you want. Okay, interim dividend is this much, which has been declared 90,000. So 60 plus 90, that's 1,50,000. 1,50,000 over here, 1,50,000 minus 0, that's 1,50,000. This way also you can find it out. Is it clear? Now how the impact of this will flow to the cash flow statement? See, it's really simple. Whatever that is declared in current year, the dividend, that has to be reversed, right, in the operating activity, isn't it? Because it's a financing thing. All right. And it's a non-cash also. But here interim dividend is cash, but still it's related to financing. So you have to reverse it. In operating, you have to add it. Only if you start from retained earning. Remember that, okay? Not always. If you start from net profit before tax or net profit after tax, you will not reverse. Only when you start from retained earning, because it's an appropriation item. Fine. And this 1,50,000 will be subtracted in financing activity because this is an actual cash outflow. Is that clear? It's an actual cash outflow. Understood? Easy. Next adjustment is, see here, sixth adjustment, income tax liability for the current year was estimated at 1,35,000. Now what is this? This is the estimation, which means current year provision. They have given you current year provision, which was 1,35,000. Okay, tax provision. So let's just open the tax provision account. In the question also we have the opening and closing balance 60 and 95. So see here, provision for tax, which is a liability account. It has credit balance, opening balance on the credit side, closing balance on the debit side, isn't it? Yes, the question has said the current year provision is how much? 1,35,000. So it will come over here. You all know it's same like dividend account only, dividend payable only, the same logic. Okay, by profit and loss, current year provision will come over here, 1,35,000. In dividend payable, what we used to do, whatever that is declared in current year only will come over here, the same logic. Okay, 1,35,000. Then you will just balance this account. Okay, 60 plus 1,35,000, that's equal to 195, and then 195 on this side as well. 195 minus closing balance 95, that's equal to 1 lakh, which is the tax that is actually paid, okay, to the government. So now what you have to do, how the impact will flow to the cash flow statement? Really simple. This provision which you have created in the current year, this has to be reversed in the operating activity if you're starting from net profit after tax or retained earnings. You have to just add back, and then the tax that you have paid, that is an operating cash outflow, will be subtracted in operating activity. You all know that. Fine, understood. Provision for tax also over. Next adjustment is, see here, okay, all adjustments are done. This depreciation is also done, right? Yes. Then what we have to do, you have to look in the balance sheet. Do you have to prepare any more ledger accounts to get more clarity? You will say yes. We have to see capital reserve. Okay, let's open capital reserve account, which is a capital reserve means it's a equity account, right? So see here, capital reserve, it has credit balance. So debit means minus, credit means plus. So opening balance on the credit side, closing balance on the debit side. Okay, to balance C by D, that is 70,000. Yeah, 70,000, 0 and 70,000. What has happened? Just cross posting you will take. See here, in the land account, what has happened? In the land account, there is a cross posting. Here, 70,000. So this will be cross posted in the capital reserve by land. Yeah, capital reserve has increased because of the profit on revaluation of land, 70,000. Is it clear? Do you have to do anything about this? No, the same logic. You have to completely ignore. It is not affecting profit. It is not affecting cash. Ignore. Okay, so that's how it is. So this account is getting tallied. No balancing figure, nothing. 70,000, 70,000. Clear? Okay. And then let's prepare the account of general reserve as well. See, opening balance is 2,50,000, closing balance is 1,50,000. So general reserve account, see, general reserve, opening balance is 2,50,000, closing balance is 1,50,000. Yeah, credit balance. So opening balance on the credit side, closing balance on the debit side. So what has happened? Why general reserve has decreased by 1 lakh? It has decreased by 1 lakh because we have assumed CRR has been created. Okay, so 2 CRR 1 lakh. Do we have to do anything about this creation of CRR out of general reserve? No. Why no, sir? Why? We need logic. Okay, see, understand. The logic is, it is not impacting profit and loss balance. It is not impacting cash. So nothing you have to do regarding this in the cash flow statement. Is it clear? Simple and straightforward. Okay, so regarding capital reserve and general reserve, nothing will happen in cash flow statement. Usually what do we do? If CRR has been created out of profit and loss, then we reverse this. When we start from retained earnings, we reverse this. Is it clear? But right now we will not reverse because it is not created out of profit and loss. Okay, general reserve. Fine. So that's completely separate. Okay, fine. So we are done with this. And then do we have to open any more ledger accounts? Debentures. We have not opened an account for debentures. So let's open an account for debentures. It's really simple. Let me just show you. Debentures account. It's a liability account. Credit means plus, debit means minus. Opening balance on the credit side, closing balance on the debit side. So see here, debentures, opening balance 0, closing balance 2 lakh. Okay, opening balance 0, closing balance 2 lakh. And then what happened regarding debentures? If you see the adjustment, you will come to know. We have issued debentures worth 1 lakh to purchase the plant, right? So debentures are issued for non-cash, isn't it? We are not getting any cash regarding that. So debentures have increased because we have issued the debentures and we have got the plant, purchase of plant. That's 1 lakh. So will this impact the cash flow statement? No, because there is no impact on cash. There is no impact on profit. Is it clear? Okay. But then the closing balance is 2 lakh. Okay. If the closing balance is 2 lakh, okay, this has to be 2 lakh. Okay. Sorry, here it is 2 lakh 50. Just rectify that. Okay, 2 lakh, 2 lakh. Yeah, the closing balance is 2 lakh. Why is it 2 lakh? It is 2 lakh because we have made additional issue of debentures. Okay, by bank 1 lakh. Is this clear? We got to know from the question that we have issued debentures worth 1 lakh to purchase the plant. That's fine. But when we try to balance out the account, we got a balancing figure over here of 1 lakh. What is that balancing figure? Why debentures have increased by 1 lakh? That's because of the debentures we have issued for cash. Okay, so this will impact the cash flow statement, which will be added in financing activity because we have raised the finance. Okay, we have got the money, we have borrowed money by way of issuing debentures. Is it clear? All the working notes over? No, there is hidden adjustment, right? 9% rate is given, so that hidden adjustment we have to do. On closing balance of debentures, we have to calculate 9% interest. So see, calculation of interest on debenture, hidden adjustment, 2 lakh into 9%, that's equal to 18,000. What you're going to do about this? In this question, there is no outstanding interest, no adjustment, nothing. So simply this 18,000 is the interest on debenture expense as well as interest on debenture paid. It's equal. So that is why you will add this in operating activity because it's a non-operating expense. You will reverse it and you will subtract it in financing activity because this much interest you have paid to the debenture holders. So that's a financing cash outflow. Is it clear? Simple and straightforward. Okay. So all the adjustment and everything are done. In detail, we have discussed about everything. Is that clear? Simple and straightforward. Okay. So now let's just see the cash flow statement. Now see here we have the actual solution, the cash flow statement of Ryan Limited. Okay, for the year ending 31st March 2021. First, let's start from cash flow from operating activities. Now we start from the profit, right? In this question, we didn't have net profit before tax, net profit after tax. So what did we do? We went to the balance sheet, to the profit and loss account balance. We did closing minus opening. We found out 50,000 is the profit, the retained profit or the retained earnings, right? So that's what we are going to start from. Closing balance of profit and loss account 1 lakh minus opening balance of profit and loss account 50,000 minus, that's equal to 50,000, and this is our retained profit. Okay, the starting profit right now. So what we have to do right now, we are starting from where? We are starting from retained earnings. We have to reverse all appropriation. We have to reverse the tax provision, isn't it? Yes, that's what we have to do. So see, reverse appropriation. What appropriation will you reverse in this question? In this question, see, can we reverse CRR creation? No, we already know the logic. We will not reverse the CRR and all. It's not an appropriation. It is created out of general reserve. Okay, it is not created out of profit and loss. We will not do anything about capital reserve. So the only thing is, if we go to the dividend account, your dividend payable, we know this is an appropriation. This 90,000, it is deducted as an appropriation from the profit and loss balance, right? So this we will have to reverse if we start from retained earnings. We have started from retained earnings, so we have to reverse this. Interim dividend, dividend declared and paid. That is 90,000 we are going to add, isn't it? In appropriation in P&L, it was deducted. To reverse, you have to add 50 plus 90, that's equal to 1,40,000. What is this? This is net profit after tax. There is, no other appropriation. Is it clear? Only this one. Fine. Okay. Net profit after tax. Where you have reached? You have reached at the second priority, net profit after tax. So now what you have to do? You have to reverse the tax provision, right? Yes. So let's reverse the tax provision. Look into the ledger account of provision for tax. Which tax will you reverse? This or this? Only the current year provision, this 1,35,000, right? So see here, tax provision, you are going to add 1,35,000, 1,40,000 plus 1,35,000, you have reached at where? Net profit before tax and extraordinary items. Is it clear? 2,75,000. In the study module, what they have done this part in the working note. That's also fine. For the better presentation, you can do that if you want, okay? Or this, both are fine. Is it clear? So now the actual solution starts. Fine. So now what you have to do? First, you have to reverse non-cash and non-operating items, isn't it? Non-cash and non-operating items. So what are non-cash and non-operating items in this question? Let's start from the ledger accounts. If we see in the ledger account, see, in land and building, first we have profit on sale. This is a non-operating income. To reverse, you have to subtract. Yeah, we have already marked everything. Let's just subtract directly. Minus profit on sale of land, 30,000. Okay. And then we have what? Profit on sale of machinery. This also we have to subtract. isn't it? Profit on sale, the same logic, minus 40,000, profit on sale of plant. Okay, next we have C, in this plant only here, in this account only, we have one more non-cash thing, depreciation, current year depreciation. This we have to add and reverse. So let's just add and reverse this depreciation, 1,35,000. Is it clear? Do you understand? Simple. Next, what do we have? Next, let's just look into the next account, investment account. In the investment account, do we have any non-operating thing? Yes, we have profit on sale. With the same logic, we subtract in the operating activity. Okay, so profit on sale of investment minus 20,000. Is it clear? Simple. Next, what do we have? Let's just look in the other ledger accounts. In dividend payable, is there anything? No. In provision for tax, in capital reserve, general reserve, nothing. So then we have one more last thing, that is the hidden adjustment, the debenture interest, right? You all know debenture interest has to be added, isn't it? Interest on debenture, the expense, you have to add and reverse it because it's a non-operating expense that has been debited to P&L. It has been subtracted. To reverse, you have to add. Okay, so interest on debenture, you have to add 18,000. Is it clear? So everything is done. If you see in the question also, you will not find anything. Okay, there's nothing given over here. Okay, and then in the adjustment also there is nothing, right? So there are no more non-cash and non-operating items. So you have to find out what operating profit before working capital changes. 2,75,000 minus 30 minus 40 plus 1,35,000 minus 20 plus 18, that's equal to 3,38,000. This is operating profit before working capital changes. Now what you have to do, now according to the method, indirect method, you have to do working capital changes, right? So how to do that? Go in the balance sheet, find out operating current asset and current liabilities. Okay, so if we go sequentially, then we have current liabilities over here. See, trade payables, current liability, it is increasing by how much? 5,000. From 1,10,000 it has increased to 1,15,000. Current liability increasing means what you have to do? Current liabilities are positively related to cash. If it is increasing, cash is also increasing. Okay, so we have to add this. So see, increase in trade payables 5,000 positive. Yeah, you have added it. And then next, what you have? Do you have any more current liabilities? See, they are saying other current liabilities, note number 4. So in the note number 4, we have dividend payable. No, for that we have done separate treatment. It's not an operating current liability. Okay, then see, liabilities for expenses, this we have assumed as what, you know, operating current liability, because they are saying expenses, right? So from 20 it has increased to 30,000. This is also increasing. This current liability is also increasing. So we have to add 10,000. Okay, increase in liabilities for expenses, 10,000 we have to add. So that's it. Current liabilities are over. Next, we have to look into current assets. For working capital changes, current asset we have to see, right? So we have inventories which are increasing. Current asset is increasing by how much? By 5,000. Current assets are negatively related with cash. If they are increasing means you have to subtract because negative impact on cash is there. That's our trick. Okay. So see, increase in inventories, you will subtract. Is it clear? Okay. Next, we have trade receivables, current asset, which is increasing from 225. It has become 250. So 25,000 increase has happened. So again, the same logic, increase in trade receivables, you will have to subtract this as well. And then next, what you have? Next, you have, see, other current assets, right? Cash and cash equivalents are different thing. That will be the last two items. We don't consider that in working capital changes. But other current asset, we have assumed this as current asset of operating nature. So this will be considered over here. So here the page is finished. On the next page, we have it. Increase in other current asset. Okay. So it's increasing by how much? By 35,000. Yeah. It is increasing by 35,000. From 65, it has become 1 lakh. So by 35,000, so that much you have to subtract. Is it clear? Okay. So then you have to make a sum. 3,38,000 plus 5,000 plus 10,000 minus 5,000 plus 25,000 minus 35,000, that's equal to 2,88,000 cash generated from operations. Fine. Now what you do, according to the format, you subtract the tax paid, right? Tax paid 1 lakh. From where did it come? 1 lakh. See, you have to look in the ledger account. Why did we prepare ledger accounts? For this only, to get the proper clarity. 1 lakh is the tax that we have paid, subtracted in operating activity. Yeah, minus 1 lakh. Is it clear? Okay. After doing this, what do we get? If there are any extraordinary items, you will consider extraordinary items depending upon inflow or outflow. If it's inflow, you will add. If it is outflow, you will subtract, right? but here there are no extraordinary items. Directly you have reached where net cash generated from operating activities. 288 minus 1 lakh, that's equal to 1,88,000 positive you are getting. That means because of operating activities you have generated this much cash, 1,88,000. Clear? Easy. Next we have to do investing activities. Okay, cash flow from investing activities. So what do you have to do for this? Go to the ledger account first. Okay, see in the ledger account, are there any investing cash outflows or inflows? Okay, so we start from land and building account. Yes, we have an investing inflow over here of 1,50,000, the sale of land, right? So let's take that. Sale of land, 1,50,000. Clear? Simple. Then do we have anything investing over here? No. In plant and machinery, yes. See again here also we have sold a plant for 90,000 inflow. We have to add it in investing activity. Sale of plant, 90,000. Clear? Then we have purchased a plant also of 4,50,000. But understand, the debenture thing, we will not consider that. How much cash impact is there? Only 3,50,000. So only 3,50,000 you have to subtract. Is it clear? Okay, understood. So purchase of plant minus 3,50,000. Okay, only this much cash has been impacted for the purchase of this plant. So only that much will impact cash flow statement. Fine. Do we have anything else in plant and machinery account? No, nothing else, right? Then in investment account, investment is also what? Investing activity item. Yes, it's an asset, long-term asset. See, do we have anything? Yes, we have sold investment for 70,000. So that will come over here. Sale of investment 70,000 you have to add. It's an inflow. And then see, we have got the dividend as well, right? We have got the dividend as well, and then we have purchase investments also. Purchase of investment, how much? 25,000. So this you have to subtract because you have paid the money to purchase the investment. So see here, purchase of investment. Is it clear? And then we have received the dividend. It doesn't matter whether it's post-acquisition dividend or pre-acquisition dividend. We have received the dividend. That means we have got the cash. It will come under investing activities. Is it clear? So pre-acquisition dividend receive plus 5,000. Okay. Pre-acquisition dividend, you have to add in investing activity because it's an inflow. Yeah, you're getting the dividend because you invested. So you have to take it over here. Fine. Understood. And then is there anything else? Let's look in the dividend payable account. No, nothing. In provision for tax, no. Capital reserve, general reserve, nothing. It won't be there. In debentures also, it's not there. Yeah. In debentures also, debentures account also, here you have purchased a plant, right? You have issued the debentures, but you have to ignore that completely. It's non-cash thing. In question also, there isn't anything. Okay. So that's all. So 1,50,000 plus 90 minus 350 plus 70 minus 25 plus 5, that's equal to 60,000 negative. Now this is called as what? Net cash used in investing activity. Because of investing activities, how much cash has been utilized, how much net outflow is there? 60,000. Is it clear? Outflow. Okay, or used you can say. Fine. Simple. After this, what you have to do? You have to do financing activities. So see here, financing activities. It's really simple. You have to start from the ledger account. If you see in the ledger account, in land and building, is there anything of financing? No. In plant and machinery? No. In investments? No. These are investing activity items. Okay, so nothing will be there of financing in that. And then in dividend payable, of course, yes, we have paid the dividend of how much? 1,50,000, 90,000 interim we have paid, and 60,000 final dividend we have paid, which was declared in the previous year. Doesn't matter, directly see the ledger account, 150 is there, bank is there, that means that much dividend has been paid. Subtract in financing, it's an outflow. Okay. And then see here, provision for tax. In provision for tax, will it impact financing activity? No. Tax paid is an operating cash outflow. Okay, it will not come over there. In capital reserve, general reserve also, there is nothing. Then what else do you have? In debentures account, check. In debentures account also, yes, we have issued debentures of how much? We have issued debentures of 1 lakh. Yes, so that will come over here. Okay, proceeds from issue of debentures, 1 lakh. Only this much we have issued for cash. The remaining we have issued for plant. So that won't impact cash flow statement. All right. So only 1 lakh we will add as a financing cash inflow. All right, easy. Next, what has happened? You have paid the interest, right? You have paid the interest. Hidden adjustment was there. just the rate they gave 9%, you calculated, you added in operating to reverse the expense, and then in financing you have to take the payment, right? Outflow, the interest that you have paid, so subtract that. Is it clear? See here, interest paid on debentures minus 18,000. And then if you see in the question, see, you have seen all the ledger accounts, then you also need to see in the question, are you missing anything? And remember, okay, whenever you're done with operating activities, still leave 2-3 lines over there so that you will have a space. If you make any mistakes, then you can fill that up. Same with every activity, leave some lines at last. Even if you are completely confident, leave some extra lines. Fine. See here, equity share capital is there, right? From 5 lakh it has increased to 6 lakh. Yeah, 1 lakh issue you have made. That's also a what? Financing cash inflow. So that will come over here. Proceed from issue of equity shares, 1 lakh you will add. Okay. And then preference shares also, there was no adjustment regarding this. We didn't open ledger accounts and all. So directly looking into the ledger accounts is not enough. Ledger account is the first priority. You will have a complete look over there, and then you'll also have a glance on the question also. Okay. And then whatever you are done with, just just tick that so that you will get to know how much you have covered in the question. Fine. So preference share capital from 2 lakh it has become 0. That means it has been redeemed. Redemption of preference shares. This much money you have paid to the preference shareholders. So it will come over here. Redemption of preference shares minus 2 lakh. It's cash outflow, right? So that's all. We have covered everything else. Okay, nothing of CRR, nothing of capital reserve will happen, nothing of general reserve, isn't it? In cash flow statement, you will not do anything of this. And then profit and loss is also done, debentures also done, dividend paid also we have taken. Yeah, this has been done. So like this, you have to go through everything. Yeah, everything has been covered. Fine, understood. So everything over of financing as well. So minus 1 lakh 50 plus 1 lakh plus 1 lakh minus 2 lakh minus 18,000. That's equal to how much? 1 lakh 68,000. This is what? Net cash used from financing activities. Is it clear? Simple and straightforward. Now what you do? Now we all do what? We add up all the cash flows. Yeah, 1 lakh 88 minus 60,000 minus 1 lakh 68,000. Right? All the three. That's equal to 40,000. What is this 40,000? This is the net decrease in cash and cash equivalents. In the current year, this much decrease has happened. This much net cash outflow has happened. Okay. And then you will take the opening balance and the closing balance. Understand the interpretation properly. See here. Opening balance is how much? Opening balance of cash is 90,000. In the beginning of the year, you had 90,000. Because of all the three activities in net, what happened? This much cash you have lost. 40,000 cash outflow happened in net. Decrease happened. From 90,000, 40,000 decrease if you consider. What's the closing balance? 50,000. Okay, that's the interpretation. Fine. Okay. So that's all. I hope you have understood everything. Yeah. See here. Investing activities, operating activities. Yeah, I hope you have understood. If you have any doubts in this, please comment down below, or you can also ask me in Instagram. All the notes and everything I will publish on the Telegram channel. Okay, I will upload in the Telegram channel. See, dividend payable, provision for tax, capital reserve, general reserve account, and then here we have land and building account, plant and machinery account, investment account. Yes, everything is over. So that's all for this video. See you in the next video.